Can you grow a small trading account with very little amounts of money? Yes, it's something that could be done, but it's not the typical way on how to make money from the market. It's not the way on how you're going to extract it and become a profitable trader. Now, I've been very fortunate to take a complete stranger that also happened to be a student to help him take $1,000 to $100,000. That was a very aggressive, small account that we scaled. After a couple of blown accounts, we managed to successfully do it in about 3 to 4 months. Now, I want to set the expectation straight. This video is not that. This is on how to properly scale smaller accounts to where it's going to eventually end up being a bigger account. This is not taking $10 into generational wealth. This is not the video for that. If that's what you think it is, unclick it. This is not it. You want to learn how to scale a small accounts, make sure to watch to the end, and I'm going to teach you how to do that properly. Now, in this video, I have with me a very special guest, which is Abneel.
Thank you so much, bro.
No, thank you for coming, honestly.
Bro, thank you.
Abneel is one of my successful students, and he's actually been hosted previously on my Swing Trading Lab podcast, where he successfully has gotten multiple payouts from prop firm accounts, and he's mainly known for being a prop firm trader and scaling his prop firm account. But he wants to learn how to scale small accounts. And I'm like, what better way to teach you how to do that, where you can be here representing the viewers, asking questions, interrupting where you don't understand. Right? So there's no pressure. Any point you have any questions, feel free to just jump in and ask me, okay?
Awesome, bro.
You ready to dive in?
Yes, go.
Okay, let's do it. Today we're gonna be talking about 3 very key components. The first one is going to be creating a proper plan to scale a small account, which it's similar, but very different from a prop firm account, right? Okay. So creating a proper plan to scale a small account. That's going to be the first thing we're going to focus on. The second thing, which is basically the backbone of a whole entire scaling of a small account, is understanding risk management. Risk management on a small account. And then third, last but not least, no plan and no risk management is absolutely nothing without the technicals. You need to have your proper technicals for a small account, right? There's a specific type of strategy that you need to use to be able to actually scale your small account when it comes to the technicals. So we're gonna be breaking down all 3 of these components. The proper plan that you need to have to scale, the risk management behind a small account, which is what's going to make or break traders, and what trades you should be focusing on and what trades you should not be focusing on. Okay, so let's start off with the plan to scale a small account, right? So a small account typically could be anywhere from, let's call it $500 to about $2,000, right? This is typically what I would consider a small account when I was working at Dunkin' Donuts.
Awesome.
This is what I believe that everybody that gets involved in trading has access to some way or another, right? If it's not 500, somewhere in the middle, this is what a small account would be like. So when it comes to trading a small account, the most important thing is that you are okay to completely lose this money, right? So you need to set the expectation straight. When you are trading with a small account, you're obviously going to have to take higher risk. And in turn, when you take higher risk, you can obviously lose. So when you go deposit this small account, think of it as if this money was already lost. That way you're not emotionally attached to it, you don't revenge trade, and you don't get lost on having to force more trades when your account is smaller, right? So picture the money that you deposit into this account that is completely gone. And that way you take trades that make more sense and you're not chasing the money. So that's the first step to the plan, so you get completely removed from any types of emotion and you're only focused on what you should be focusing on. Now, when you have your small account, you should be looking to take anywhere from 1 to 2 trades a week max, because every single trade that you want to take has to be the highest probability trade setup, right? You can't afford testing your strategy. You can't afford a loss, because when you take a loss, it's going to set you back very far in the account. And it's going to be very hard for you to make it back. It's not like a prop firm account if you were to risk 2-3%. So let's say you want to take 3 different types of trades on your prop firm account, risking 1%. If 2 of them lose at 1%, 1 of them wins plus 2% with the risk reward, you're at break even. This is not like that. You can't even take 3 trades at the same time because you literally blow the account.
Of course.
So the max amount of trades that you want to take in a week is anywhere from 1 to 2 trades.
Okay.
If you could even take 1, even better. Now, these trades that you're taking that are 1 to 2 trades a week, the most important thing is going to be the RR, which is what?
The risk to reward.
Correct. So RR is risk to reward. Now, typically the normal that you would have for a prop firm account or for any other account could be anywhere from a 1 to 2 to maybe a 1 to 2.5, which is great, right? This is a profitable risk to reward. You can have 5 trades that you lose, and out of these 5 trades that you lose, the 5 trades that you win will obviously outweigh the losses. Because all of this right here will be -5, and if this has a 1 to 2 risk to reward,
10.
plus 10, you're obviously left with an overall profit of 5, right? So with these small accounts, the most and crucial and important thing is going to be that your risk to reward begins from a 1 to 3 and above. So your risk to reward needs to be at a 1 to 3 plus. The larger the risk to reward, the better. Because you want to make sure that, one, since you're being very selective with the trades that you're taking, you can maximize those wins as much as you can. Now, this goes back into having the best quality trades, and we'll break that down once we get to the third step. But this is the base core plan of scaling any small account. Accepting that you have a small account and that this money is basically gone. Second, you need to focus on quality over quantity, and that having a high risk to reward is what's going to actually scale the account for you. Any questions?
So how much is the 1% of the total of the account? Let's say if we choose $2,000 account, how much will you risk on the first trade?
Yeah, so that actually leads me perfect to the next part, which is going to be the risk management for this account. So we don't typically do 1% of when we're risking on these small accounts, right? Because if you do 1% of $2,000,
it's 20 bucks.
20 bucks, right? Like, you know, that's not even going to pay for a McChicken nowadays, right? So when it comes to the risk management of the accounts and what you risk, that's where the backbone of this is going to be built, right? So now we're going into the second topic, which is going to be the backbone of growing any small account and is the most important, which is risk management, right? Don't mind my handwriting, right? So risk management is by far going to be the most important thing. So for this example's purposes, let's kind of go right in the middle of the account balance that we decided to start off with. Let's say that we have $1,000 starting balance, right? This is our starting balance with our account. So we understand that we have to take anywhere from 1 to 2 trades a week, and we understand that our risk to reward needs to be a minimum of a 1 to 3 plus. So on these 1 to 2 trades, how much do we risk? Great question. Now, typically what we would do as a prop firm trader is the typical risk is, you know, the standard to stay within the rules is 1 to 2%, right? Max. So this 1 to 2% is literally the max that you can possibly do, because your drawdown is a total of 8% on some prop firms or 10% on other prop firms. Now, that is because the prop firm sets those rules, and you have to create your own rules so you don't obviously breach them. Now here, we set our own rules, which is good and bad, because since we're setting our own rules, we can obviously make a mistake, and we're the ones holding ourselves accountable. Now, for the prop firms, the standard is a percentage, because you have higher amounts of money, right? Or the $100,000 account, if you were to risk 1%,
it's $1,000.
It's $1,000, right? So that's a significant amount of money, right? $1,000, you catch a 1 to 3 risk to reward, it's $3,000. It's a great amount of money. And that's just risking 1%. So when you have anything over, I like to say $25,000, is where you should focus on the percentage gain, which is what is happening here. Anything below $25,000, it's all the money game, right? So this is where we're going to transition the risk management into the money game. So risk management, when you're scaling a small account, is no longer percentage. It's the money game. So this is where you need to figure out, okay, you know what? For the $1,000, I want to create the base that I want to risk $250, or I want to create the base it be $350. It's whatever you feel comfortable with, but you have to make sure that you have at least 4 or 5 trades in you before you would obviously lose the account. Now, again, this is very high risk, but it's the only way to scale the account. So these $1,000, you go very high risk at the starting point, and then as you start creating a bigger account, you lower that risk so you're not prone to blowing this account. So this is where the money game comes in, and you have to find what you're comfortable with risking on the first couple of trades. So what would you feel comfortable with risking on these $1,000?
Probably 35% at $350.
Okay, $350.
Yeah.
Okay, perfect. So now, the first trade that you're going to take on scaling your small account is the most important trade.
Yeah.
Because that trade will either make or break you.
Yeah.
It's going to either set you back or it's going to give you off to a great start, right? So you decided that you wanted to risk $350. Now, if you catch a 1 to 3 risk to reward to that, it's basically $1,000.
Yeah.
Right? So this is what you're going to risk. And then this is
Reward.
your potential reward, right? After fees and after everything, you're gonna have about $1,000 because we're always going for a 1 to 3 RR. Now, the best way that I like to explain your first trade is gonna be with a punch card. And I actually learned this from Mr. Warren Buffett, right? So let's say I give you this punch card, and these are all the trades you have to take in your life. So the trades that you can take in your life are on this punch card right here. There's going to be a total of about 15 trades inside of here. 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Let's call it 20 trades. So what you should do when it comes to taking a trade in your small account is if you were to have a punch card like this. Punch card. I'm terrible at writing, right? So once you mark off all of these trades,
Okay.
you're done. You can never trade ever again in your life. So what is that going to make you do? That's going to make you be very selective on every single trade that you're going to take. You're going to think 2 times, 3 times, 4 times before you enter that first trade because of the importance and the impact that this risk has on your $1,000.
Yeah.
So whenever you go take your first trade, whatever it is that you decide to risk, you need to make sure that that trade is 100% worth risking those $350.
Okay.
Because the moment that you do take that trade, you're down 1 punch, you got 19 left to go.
Yeah.
So you need to make sure that that probability is a very high probability trade setup, and very high probability trade setups that can potentially give you a 1 to 3 risk to reward don't come every single week, right? They can come maybe once a week, maybe once every 2 weeks. And this is not the time to learn a strategy. This is not where you learn
how to trade.
No, not at all. This is once you already have some type of understanding how trading works and you've made some money, you've lost some money, and you want to try a different approach, whether it's prop firm or personal, this is where you go and put that into practice. But you do not learn a strategy off of doing this approach. So if you're learning a strategy right now and you're a beginner or even intermediate, go watch other videos, get educated. This is not the moment for you, right? So this is for someone like Anil that has been trading for some time, has made some money, and is ready to take on a different type of trading. Or maybe you've passed some prop firm accounts, you've made it to that funded stage, but you never get a payout because of the rules, maybe because the rules aren't set in your favor. Trying something like this where you can set the rules for yourself.
Yeah.
So back to the punch card. So let's say the first trade that you're going to take wins, right? Because you were very patient, you were very selective with your trade. Cool. So now your $1,000, you have basically taken it to, let's call it $2,000. Now that's fantastic, right? Because you've technically doubled your account by just technically risking 30% of your account, which is great. Now, all you have to do is then determine, what is my goal with these $1,000? Is my goal to take it to 10,000, 50,000, 100,000, a million, right? What's your goal? You have to be realistic with what you're trying to do and how much experience you have. So what would you say would be your goal with these $1,000?
Let's say 100K.
100K. Okay, so your goal to take $1,000 to 100,000 is very optimistic goal.
Yeah.
Like, it's very challenging to do something like that. Is it possible? Sure. It's just very high risk. Now you have to determine how fast do you want to get there. Do you want to get there in 6 months? Do you want to get there in a year? What is something that you envision yourself doing?
Probably in 6 months.
In 6 months?
Yeah.
Okay, so taking $1,000 to $100,000 in 6 months is possible. Now you have to do the math reverse. So let's say your goal is $100,000, right? We're gonna keep our punch card here because it's very important. So let's say $100,000, right, is your goal. Right now you are currently at $2,000 because you just won a trade. So this trade that you just won is your balance. Now, this goal right here that you want to have in 6 months, how many weeks in 6 months?
24.
24 weeks, right?
Yeah.
Okay, so now what you have to do is divide this in weeks. So let's do like this, for example. Let's do 1 week, 2 weeks, 3 weeks, 4 weeks, 5 weeks, 6 weeks, 7 weeks, 9 weeks, 10 weeks, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, right?
Yeah.
1, 2, 3, 4, 5, 6, 7, 8, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, okay, we did 25, right? 24 weeks. So your first week, you've already taken $1,000 to $2,000, right? So now this starting balance is 2K. Now, your end goal is $100,000, right? So that's your end goal by week 24. Now, what you have to do is go backwards. If technically you just doubled your account, obviously if you were to go 2K, 4K, 4K to 8K, 8K to 16, 16 to 36, 36 to 60, no, what is it?
32, 64.
64, right there is where you would be at 120. That's if you were to double your account every single week, you'd basically be there halfway.
7 weeks.
7 weeks, which is a very aggressive approach to do.
Yeah.
And that is very unrealistic. Could it happen? Yes, because you're setting goals on a weekly process. That's how I did it when I took this student. It took me 3 months to do it. Now with you, I would try and achieve it by this time. So I would do the math to where I can make it make sense to hit by the 24 weeks. So for example, instead of taking 2K to 4K, maybe we take 2K to 3K.
Okay.
And then if we take the 3K instead of to 6K, we take it to
4.5.
4.5, 5K. And that 5K instead of 10, we take it to 7. And then you slowly do the math until then it gets to that point. So then now you're no longer risking $350 or 35% on your account. What you would end up risking is going to be, let's call it $150 from your account, or call it $200 on the account now. So now what you're risking is 10% rather than 35%. So if you were to lose a trade, you don't have a major setback.
Oh, yeah.
Does that make sense?
Yeah.
Now, this is definitely possible, but if you were to look at this, how many weeks do we have here? We have 24 weeks.
Yes.
And how many trades do you have in your punch card?
20.
19.
19.
Because you already took your first trade.
Yeah.
So is this possible? Obviously, sure. We can add a little bit more trades to our punch card and we can obviously make it 24. But then that means that you would have to win every single trade for the next 23 trades,
Yeah.
which honestly, it's pretty much impossible,
Yeah.
right? Could it happen? Sure. But if I were to grade this from 1 out of 10, I would give this a 10 out of a difficulty, right? So let's set a more realistic example on growing a small account. Again, if you're looking to flip an account, that is not what this video is about. I just want to show you how, if you have a goal, you can work it backwards, even if it's something as optimistic as this. So let's set a realistic example when it comes to actually scaling a small account rather than flipping, right? So for example, let's say our goal is to scale our account from $1,000 to $10,000, right? So our goal is to take these $1,000 to $10,000. Now, the same principle applies. What do you feel comfortable with risking, knowing that this is your goal rather than, let's say, $100,000?
Probably 15% to 20%, $150 or $200.
Okay, so $150, right? If you lose $150 of 1,000, you're still left with $850, $700 after some fees. You'll be fine, right? Yeah. So you're okay with risking, let's call it $150. Now, same exact principle applies. This $150 with a 1 to 3 risk to reward will then give you your $450. Yeah. $450 will then be your account left, right? So you have 1,450. Same exact principle applies. You can either continue to stay with the same risk, or you can decide to lower it.
Yeah.
Or you can decide to raise it. The consistency of this risk management is entirely up to you. There's no proper strategy on when you should risk more or risk less, depending on the technicals, and that's what I'm going to be showing you next. But for now, the basis on how to actually scale to an account is by doing the math backwards by when you want to hit it and focusing on quality trade setups. If you were to lose 2 trade setups in a row, so for example, let's say our first 3 trades are losses, you're probably down so bad into the account that you might either have to redeposit into it,
of course,
or change the goal completely in terms of time.
Yeah.
Right. But let's say your first 3 trades are winning trades. Well, then you might want to continue with that same risk management or maybe even double down. But let's say you have an inconsistent start where you have 1 loss, then you have a win, and then you have a loss. Now things could get tricky. And the most important thing is finding something that you're comfortable with. Whether you win or lose, whether you lose, win, or win.
So basically what you are telling me is what is going to get me to the goal is the patience, not how aggressive I am with the trades. Because in prop firms, for example, for me, I used to do a lot of aggressive trades. In this case, no, basically.
No aggressive trades at all. Like the patience is going to pay, right? That's our whole reasoning for the punch card, which it forces us to focus on quality trade setups. We're not testing anything new here. You're not learning anything new. You know exactly what you're looking for when it comes to the markets in terms of the strategy. And then all you have to do is just execute it and you don't have to think about it.
Awesome.
Right?
Yeah.
So that leads us perfectly to the next part, which is going to be the technicals, the extra strategy. What types of trades are you going to be taking? Are you going to be taking counter trend trades? Are you going to be taking pro trend trades? So let's break everything down right now so you can focus on the best quality trade setups. Now, going into the third point, which is going to be the technicals, right? Now, this is where some people are going to probably overlook this and maybe skip it, but it's probably the most important part.
It is. Because
you can have the money, you can have the risk management, but if you don't know the types of trades that you're taking, you don't got nothing.
Yeah.
Right? So there's, for me personally, 2 different types of trades. The first trade is going to be a pro trend trade. And then we have the other, which is going to be a counter trend trade, right? So there's 2 different types of trades. If this market is all going bullish, you want to continue buying with it. If this market is going bullish, you want to predict the high of it to catch the sell. Yeah. High risk, low risk. Now, people get both of these confused. Some people have this gambler's mindset and they think, oh, high risk equals high reward. I don't know why they think that makes sense.
Okay.
It's completely wrong. High risk in trading does not equal high reward. It actually equals exactly what it is.
Yeah.
High risk. Low risk equals high reward because the odds of you losing a trade that has a low risk of losing means that you have a high reward. Yeah. So meaning you can risk more on low risk trades because it can make you more money. Yeah. If the odds of you losing are a lot less, it makes more sense
to risk more.
It's like, for example, right now, if Mike Tyson were to get into the ring with, I don't know, say someone, who?
You.
Okay, yeah, you're gonna bet on me all day, right? I'm gonna win. You know, that's a low risk bet. The odds of me winning Mike Tyson are very high, right? You know, at least I like to think that. Well, that's the example that I want to make. If you know that one is going to have more odds of winning than the other, you just simply bet heavier on that side because the odds of you losing it are not there. So this is consisted of pro trend trades and counter trend trades. Now, pro trend trades and counter trend trades, as you know, we're going to educate the people here today, are broken down by 3 simple time frames. The first going to be the weekly, the second going to be the daily, and then the third, the 4-hour, of course. Now, both of these are the same but different. The weekly time frame will let you know, obviously, where markets can go for the next 2 to 3 weeks, the daily for the next couple of days, and the 4-hour for the next couple of days. Now, a pro trend trade, right, which was the example that we're going to set here, pro trend trade is going to be when all of these are working together. When this one, and this one are all the same. Meaning this market, for example, is bullish this daily time frame, for example, is bullish, and then the 4-hour time frame is also bullish, right? This is the exact same time frame. Let's call this example right here Euro USD, for example, right? So Euro USD, right now the weekly time frame is bullish, daily time frame is bullish, 4-hour time frame is bullish. The most logical thing to do right now is buy, right? Just,
of course.
It makes sense to buy because you're going to be trading with the trend.
Yeah.
This is what would make this trade a low risk trade because you're trading with the trend. Now, obviously, if the market is all the way at a high point right now, you don't want to trade at a high point.
Yeah.
Makes no sense. It's like buying Bitcoin when it's at the high. What was the height of Bitcoin?
126.
126.
Yeah.
Why would you buy Bitcoin at the highest point it's ever been, right? Like,
Yeah.
It's like right now gold. What's gold at right now? Like 5,000?
5,000. Yeah. Today was 5,100.
5,100.
Yeah.
There's still people buying up there. That makes no sense to me. Like, you don't ever want to buy something at the highest point. So yes, you are bullish, you are at the highest point, but you want to wait for what I like to call a discount, which is also that retracement. So first you need to identify if the market has these 3 time frames together, right? So let's say, for example, this time frame is bullish, 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 right? This is great. What we want is this type of discount for this market to have a retracement. Now, we want for the retracement to happen only on the weekly and on the daily.
Okay.
Right? We want this retracement to come back to a weekly area of interest or a daily area of interest. So this weekly area of interest is the same as here as on the daily area of interest. That's what we're anticipating to come back. That's what we're anticipating. This is where the weekly area of interest is now anticipating, right?
Yeah.
So if you notice, for price to come back to this weekly area of interest, this still remains as the higher low. That still remains as the higher high, right? Still very bullish. This is still the higher low. That's still the higher high. We're still very bullish. But now, if this market comes down here, guess what? This used to be the higher low. This used to be the higher high. We now shifted bearish. So now the 4-hour time frame is no longer in our favor. The weekly is still bullish. The daily is still bullish. And now the 4-hour time frame is technically bearish. So now we don't have a full pro trend trade because we're missing the 4-hour time frame. So this would now make this go from a low risk trade to a mid risk trade. Because technically, yes, we still have this time frame in our favor and this one, but we're missing the third one.
Yeah.
Now remember, you have a punch card that has 20 trades that you can only take. Can you take this trade? If you want, you know?
Yeah.
You can do whatever you want at the end of the day, right?
Yeah.
Does it make sense to take the trade?
No.
Probably not, right? Because if you have other trades that have higher probability and you can get this time frame to be bullish in your favor as well, you want to wait for that.
Yeah.
This is where what you asked me, the patience game. Patience. You want to make sure that you can wait for that proper entry before entering the trade. So now that the 4-hour came bearish into this area, what you would have to wait for is for this to shift bullish again. So then you can have the 4-hour go bullish, back with the daily, back with the weekly.
Yeah.
And then at that point, once that shifts bullish, you have all 3 time frames in sync, go ahead and decide to take your first trade. So this is the basics of trading with the trend as a pro trend trade. Now, let me identify to you a high risk trade, which is technically a low reward trade. Now we have a low risk trade, which is also equivalent to a counter trend trade, also known as a CTT, counter trend trade. Right? Same thing. It will always be consisted of the weekly, the daily, and the 4-hour. Correct. Right? So you have weekly, daily, and then the 4-hour. Now, for this example, we're going to set a market that, for example, is like this. So that's the weekly time frame. It was bullish at one point, we shifted bearish.
Yeah.
This is the daily time frame. The daily time frame will obviously have a lot more structure. Right? And the daily time frame is technically like this. So the daily time frame, is that bullish or bearish? It's a little bit tricky, but
I would say bearish.
Bearish. So like if that's the lower high, that's the lower low, lower high, lower low. That technically is the new lower low. lower high. Technically, it's bullish now.
Bullish, okay.
Yeah, bullish. So then the 4 hour, we're just gonna keep it simple. We're only gonna draw this market structure right here.
Yeah.
So that's the 4 hour structure right there.
Okay,
So we're only
bullish.
focusing on that, correct. So now on the weekly time frame, you have the weekly time frame that is currently bearish.
Yeah.
Daily is bullish. And then 4 hour is bullish. Now, this is a counter trend trade. Why is this a counter trend trade? Well, because technically, yes, you could buy because you have both of these time frames in sync.
Yeah.
But you have to understand where you're buying to. You're buying right into this weekly structure level, this weekly area of interest, where price is literally setting up the perfect sell to continue going to the downside. So yes, you could be buying with the daily time frame going up, you could be buying with the 4 hour going up, but you're buying it straight into a resistance that price is going to reject from to then head to the downside.
Yeah.
So this would be a counter trend trade because some people only like to look at the 4 hour and the daily and they completely disregard the weekly. And then they question why they lose. They question why they're wrong and what they're doing wrong. Well, what they're doing wrong is not looking at the higher time frame. The higher time frame will always dictate the direction of where the lower time frames will go.
Yeah.
It takes 7 days or technically 5 days for one candlestick to form on the weekly. That's a lot stronger than one that takes 24 hours or one that takes 4 hours.
Yeah.
So if you have a trade that is technically bullish on both of these time frames and you're going against the weekly trend, which is what you're doing here, that is a counter trend trade. That is a low risk trade.
Yeah.
So this would not make any sense to trade in your punch card.
Yeah.
It's absolutely pointless.
Of course.
If you would want to take this trade, what you would have to do is wait for the daily to shift bearish, wait for the 4 hour to shift bearish, and then now all of this turns from bullish to then bearish, and then you're trading with the trend.
Yeah.
Any questions? I know you understand this at this point.
Yeah, I understand. Yes. So no question.
All right, so now that you understand this, I'm gonna let you into some secrets on how to scale a small account, right? A lot of people are curious on what's my secrets behind it.
Okay.
And this is my plan, right? This is what I do no matter what. This is my way in executing, scaling any small account. Now, I have a very unique secret or hacks onto scaling a small account that a lot of people, for some reason, they overlook, right? So these are going to be some secrets to scale a small account, right? So the first secret, which is the most obvious, is going to be leverage. Now, leverage is very important when scaling small accounts simply because it will give you more access to your money. So this is, for example, this has happened to me in the past where I've tried to take $1,000 and I've tried to take it to $10,000. But I had a 1 to 100 leverage. The problem with that is that I decided to start risking $100 on the account. What ended up happening is that I started losing 3-4 trades in a row. When my account was at about $500, I could no longer risk $100.
Yeah.
I was only able to risk
$50.
40, 50 bucks because of the spread, what I had available in margin. So if I were to swap out my leverage from a 1 to 100 to let's say a 1 to 500, I would have never had that problem. So I could have continued my same risk that I had from the start. I could have kept it going even when I lost 4 or 5 trades in a row because here I have much more access to my money. So leverage is good and bad. It's good because it lets you, for example, in a situation like this, stick to your exact same risk management. Bad because if I would have started off with these $1,000 and I decided to risk the full $1,000,
you overtrade or over-risk.
I could pretty much do that. But if you have the risk management in place, how we previously said before, technically there's no risk behind this. It's almost like having a car that can go 200 miles an hour and you never go the full 200 miles an hour. You just go up to the speed limit just really fast.
Yeah.
That's exactly what this would be. Or it's like, let's say you have a credit card with a limit of $1 million. Doesn't mean you're gonna spend $1 million.
Of course.
You just have access to it to whenever you want. You don't have to call the bank to raise your limit or approve some things.
Yeah.
So this is the exact same thing. You just have much more access to the current money that you already have in the platform.
So basically this is the best leverage you recommend us watching to scale accounts?
I think you do not need more than a 1 to 500.
Okay.
I'm lying. I have traded with a 1 to 1,000 before.
Okay.
And there's no difference.
Oh, okay.
I feel like, I mean, there could be, I just didn't risk as much that the 1 to 1,000 let me. 1 to 500 leverage is
Perfect.
it's overkill, it's perfect. You don't need more than that.
Awesome.
That will be enough for you to be able to risk what you want to risk, for sure. So now this is one of my first secrets, right? When it comes to just trading account as a whole. My second secret is no trades on Sundays. No trades from Thursday on. Now,
And where's that?
okay, great. No trades on Sunday because when the market opens on Sunday, the volume is very low. And typically the volume won't really kick into the beginning of New York session on Monday. So there's no reason on entering a trade when there's no volume because you don't need to be overexposed on a trade that simply makes no sense. And that will save you one, fees that you're gonna pay when you take your trade on your small account, then you need to save as much money as you possibly can. And two, if you do take a trade on Sunday, by the time you hold it on Tuesday, you're technically holding it for 2 days almost. So swap and all that stuff will add up. Well, it'll eat into your profit, right?
Yeah.
So no trades on Sundays. And the second is going to be no trades from Thursday onward because everything after Thursday, think about it. If, let's say you're going to be taking a day trade approach and let's say you have a 20 pip stop loss and then you have a 60 pip take profit, well, you would technically need, technically you would need a 60 pip take profit for a 1 to 3 risk to reward.
Yeah.
You probably won't have any volume that will get the trade to hit those 60 pips after New York session on Thursday. So if you do not enter a trade by 8 in the morning or latest 9 in the morning Thursday, you cannot take a trade because you simply will not have enough volume to make that trade reach your take profit before it hits.
Yeah.
Does that make sense?
Yes.
So this is to save yourself money and be in a slow trade, and this is to save yourself from the trade potentially not hitting your take profit.
Yeah.
These are two of my secrets when it comes to when to enter a trade and when to not. So your main focus is Monday through technically Wednesday London session. These are the most volatile days that you want to focus on anyways.
So when it comes to your entries, you said from Monday to Wednesday, but when is the best time? Because you was talking about volume, but volume, in my understanding, the volume kicks on London and New York for you. Which section is the best, or it doesn't matter? You only look for the setup when it's in on area of interest, or you exactly wait on London to take a trade without no setups? So
It's a great question. Great question. So I guess a third tip could be if you want to have your trade hit your take profit the fastest, it would be focus on entering your trades on London session. Now, the reason why is because if you take a trade in London session, let's say you take it at 1 in the morning, right? We're talking about EST, right? So 1 a.m. you take the trade. You have 1 a.m., 2 a.m., 3 a.m., 4 a.m., 5 a.m., 6, 7, 8, 9, 10, and 11 in the morning, where you have
full volume
in all of these sessions. So as soon as you enter your trade on London session, your trade is moving to your take profit or your stop loss immediately from once it starts. If you take a trade in New York session, you will have a couple of hours of session, but then after this you have Tokyo and Sydney session that will hit as soon as market closes, and then you're basically waiting until the volume kicks back in at the beginning of London session. So for me, when it comes to the account flips, the best trades that you can possibly ask for, whether it's Monday, Tuesday, or Wednesday, is to take it at London session or before London session. The earliest that I would take a trade, could be anywhere from 11 p.m. EST onwards. So almost midnight, pretty much. So this is a great question, and this is a hack because you get the full volume back to back.
So other question is, when your trades hit TP, let's say you enter Monday and Tuesday your trade hits TP, you done for the week, or you keep looking for more trades or more setups during the week?
That's a great question, and that is what would come down to an experienced trader to make a decision on. And There's some times where calling it quits as soon as you win a trade is the right thing to do. There's also where it's the wrong thing, where you might miss out on another opportunity. The way I like to look at it is a great business opportunity doesn't come every single week, right? If you're gonna invest into a great company, a great startup, it's not gonna come every single week, right? They'll come every once in a while. And I like to look at trading very similar to that. A great trade won't come every single week.
Yeah.
So to answer that question, it would have to directly go to where are you in your account, right? So let's say, for example, like once again, we started off the account with the $1,000. And let's say we won our first trade risking $250. Now we're up $1,750, right? So our account right now is at $1,750, and we won our trade, and it's Tuesday afternoon. We entered the trade Monday London session, hit take profit by Tuesday. We still have Tuesday, Wednesday, Thursday, Friday for the market to move into our take profit. Should you go ahead and enter another trade or not? Now, this is where it's going to completely be decided up to the trader. I don't believe that you should just say, oh, one and done, and that's it, I'm done for the week. Or if I lose a trade, I'm done for the week. If I win a trade, I'm done for the week. I believe if there's an opportunity, you take it, because you don't know when another opportunity will come again.
Awesome.
So that really is going to be up to the trader and what you are comfortable with risking, because maybe there's another great opportunity that presents itself in Wednesday, and then you don't have another trade for another 2 weeks that go by, and your only opportunity was on Wednesday. So putting this fixed rule on such an unfixed industry, because the market is so random, right? It just moves random in every single day. I don't think it's accurate, and I think that I think it's more of like a superstition to people than a logic, right? Like you shouldn't base your personal results on your trade on the opportunities that the market gives you. So like if you want to trade or not, that doesn't affect the opportunities that the market's going to give you. The market doesn't care. It doesn't know if you won or lost. It doesn't matter. So whether you win or lose, that next opportunity was going to present itself no matter what. You just have to be ready to make the decision to enter that trade, and if it makes sense to enter it or not. So to answer your question, that would be directly to what you feel most comfortable with.
Awesome.
That's a great question. Okay, so now understanding some of the secrets to scale a small account. These are some of my secret traits that I carry under my sleeve. Let's talk about some things that you might really run into. Which is almost inevitable. And that's going to be the mind. The mind, right? We're gonna draw a little brain here. It's a terrible brain, but that's the brain, right? Which is going to be the psychology of a trader. This is what will make or break you
and your money.
And your money, and your small account, your big account, your every account. You can have everything in check, and if your mind is not properly set up, you're cooked. And I'm sure every single trader can attest to this. And I'm just going to write down things that don't help your psychology. Right? These are things that can maybe make you feel better, but if anything, it does you more damage than good. So these are things that are not good for your psychology. One is going to be motivation. Motivation. Motivation is not good because it's temporary. It only lasts a short period of time. And the moment that you don't have that motivation, you seek the motivation once again, and it actually ends up digging you into a deeper hole, because it's this endless, never satisfied cycle that you need to chase. It's almost like once you are, like let's say once you're into drugs, right? Like once you get off of it, you need to get back on it. That's what motivation is. It's a drug. It's not good because it ends up messing with your mind. Another thing that is not good is FOMO, fear of missing out. Your goal here is to scale a small account. If you're watching this video and you're still all the way at this point, you know you're not here going to create generational wealth with $10 or $1,000 or even $10,000. So don't get fear of missing out if you miss out on some opportunities. Let's say you're being very selective on the trades that you want to take, and you wait for certain extra confirmations and you don't take the trade for whatever reason and you miss out on it. don't think that the next trade is going to leave you as well because you're waiting for an extra confirmation. And if it leaves you, it leaves you. If it doesn't, it doesn't. You move on to the next trade. Do not have fear of missing out. Will you miss out on opportunities? 100%. You watching this video right now, I can almost assure that you haven't been trading more than 5 years, right? I can almost assure you that. And just to let you know, you've been missing out on opportunities in the markets for the last 25 years. So if you just missed a trade this week or next week or the following week, think about all the other opportunities that you've missed out on for the last 2-3 decades that the market has been presenting.
Yeah.
So are you really missing out on something? No. These are all new opportunities being presented to you, and they're not going to stop. What will stop you from capitalizing off of these next opportunities is your mind on fear of missing out while you're going to chase trades. Next is the classic, greed. I wanted to take the $1,000 to $10,000. And you get there and you're like, well, that was easy. Now I want to take it to $1 million. And then what ended up happening, you end up upping your risk, you end up taking more trades, forgetting what you did to get you to the point that got you to your current account balance, and then you blow your account. Yeah. Be content with what you have done. Now, I'm not saying be satisfied or celebrate or be happy, but realize and have a moment of realization. It's like, holy shit, I just did something that 99% of the population can't do. 99% of the population can't even look at a chart and understand if it's going up or down. And if you can already withdraw some money from that, you're already ahead of the game by 99%, if not almost 100. So greed at any given point, don't feel the need to risk more to make more. If you know how to read the charts and you know how to find solid opportunities, the money will come. It will take time. It's not going to come from one second to another, but the money will come. Greed is what is going to then fund your emotional decisions. I'm sure we've all been there when either we've gotten into a fight with a girlfriend, when something is going on with, you know, a family member, whether they are supporting you or not. Parents could be fighting, whatever's going on in your life, right? Lead you to make an emotional decision. Oh, I need to make this money right now because, you know what, I want to get out of the house, or I want to show this person that I'm worthy of this, or I want to do this. Any decision that you're making a trade based off of how you feel is already a loss. If anything is based off of how you feel, you're cooked. You're completely toasted, right? You can only take a trade based off of what the market is telling you. And if the market tells you it's a good trade, you take it. It's not what you want to feel towards a trade. Next, we have probably the most important. Well, they're all very important. Procrastination. You know what? On my next trade, so you take your first trade, you take a loss, and you're like, you know what? The next trade, it's gonna be a pro trend trade. It's not gonna be a counter trend trade. You realize that a pro trend trade could take some time to get ready. It might take 1 or 2 days, and then you get entertained in the between by a counter trend trade. You take it, and then you lose again. And go, you know what? The next trade, I'll risk a little bit more and actually make it a pro trend trade. You take that pro trend trade, you happen to take a loss as well, and now you're mad at life as to you know why you're not successfully scaling your small account. It's because you're procrastinating the foundation of how to scale a small account properly. If you say that you're going to go out there and do something, just do it. Don't procrastinate as to something needs to happen in order for you to do something. Oh, I need to get a raise at my job in order for me to start, or I need to be in a certain time zone to be able to learn how to do this. No, when you find the time, you do it and you get with it. But the more you procrastinate, the longer all of this is going to build up inside of your mind, because you're going to be seeing other people capitalizing off of this opportunity, and then you're not. And now you're just going to, like, everything here is just literally going to 2x because you've been procrastinating for who knows how long to do the right things that you know you should be doing. You know you should be okay with risking a certain amount of money. You know you have to stick to that percentage, and you know you have to learn a strategy. It's very simple. Don't procrastinate on things that you already know. You're seeing it every single day online with people explaining the foundations about it. But if you procrastinate simple things, like, oh, okay, when I get back home, I'll do my bed, or I'm going to wash the dishes. And okay, when I get back home later, I'll throw out the trash. all of these small things that you procrastinate that could get done in honestly less than 2 minutes.
Yeah.
It takes you 2 minutes to do your bed. It takes you 2 minutes to wash the dishes, 1 minute to throw out the trash. When you get back home from work or from whatever it is that you're doing, your mind is clogged with all of these other micro things that you didn't do. And now you put an excuse, you procrastinate as to why you can't get started or as to why you can't do something, because you procrastinate on doing things on your personal life that then get involved with this new side hustle that you want to join or this new business that you want to start. All because small things that you've done have built up to hold you back from what you actually want to do. So don't procrastinate anything. Now, all of this built up will literally be equal to you. This is going to be the direct representation of who you are. If you as a person to people, or you as a person are emotional, you as a person are greedy, all of that is going to reflect to the markets, and it's going to come back to you 2 times fold. So you need to approach the markets as a trader. And I say this all the time, for you to go out there and become a bodybuilder, what do you have to do? Well, you have to become a bodybuilder.
Yeah.
You have to go to the gym, you have to eat like an animal, follow a strict diet, count your macros, hit the cardio, take maybe some enhancing supplements, right? Maybe, right? If you want to be a bodybuilder, you have to do what it takes to be a bodybuilder.
Yeah.
If you want to be a trader, you have to do what it takes to be a trader. You have to turn into a trader. You have to be okay with taking risks. You have to be okay with staying up late. You have to be okay with not even making money at times, because that's just how it goes. The same day you walk into the gym is not the same day you get abs. It's just not how it works. Now, with that being said, we have discussed some pretty core foundations of any trader. Whether you want to have $1,000, $10,000, or $100,000, $1 million account that you want to scale at a slow rate, at a fast rate, you need to have these key foundations. You need to have your core plan. You need to have a certain approach on how you're going to approach it. You need to have a risk management, because without that, there's no longevity on how you're going to scale the account. And then most importantly, you need to have a strategy. A strategy that is going to let you understand when it's the right time to take a trade and when it's the right time to not. You can take on literally this dude did not know how to trade previously. He learned the strategy. And so how much are you up this month right now?
This month, 41,000.
On your prop firm account?
Yeah, 41,000.
Now we got to get you to your personal account so you can scale this. So you're going to deposit those 41,000 in your personal, or you're going to take a piece of that?
Probably a piece like 20K.
20K?
Yeah.
Okay, cool. So you technically fall under the small account, so you could still do something pretty aggressive like this.
Yeah.
But without a strategy, he would have never had the type of resources that he has now to be able to not only scale a prop firm account and now attack his personal account. You guys want to learn a strategy, get on calls with me and other students just like himself, where we review your trades, see what you're doing wrong, double down on what you're doing right. Click the link in the description down below. We'll break down for you exactly the trades that we're interested in trading for the week, and letting you guys know what you're doing wrong and be part of a winning community. You guys want to know more about it, hit the link in the description below. Hope you guys enjoyed this video. Make sure to hit that like and subscribe button. See you guys in the next one.
Don't forget.
See you guys.